This week on Wealth Track, with the threat of higher interest rates looming in the distance, bond investors are starting to flee bonds. Are the best days of the bond market over? LumaSales award-winning bond fund manager Kathleen Gaffney and BNP Paribas high-yield guru Martin Fridson show us where to find shelter and income. Next on Consuelo Mack Wealth Track.
The company you keep is also the company we keep. Together, we help provide a lifetime of guaranteed income and investment solutions.
Additional funding provided by LumaSales, investors seeking exceptional opportunities globally. Research affiliates, an efficient index for an inefficient market. The Wintergreen Fund, your home for global value. Rosalind P. Walter, and the Dreamin Foundation.
Einhorn, Berkowitz, Grantham, Miller, Swenson. Learn as much as I do from these rare conversations with our exceptional guests. Check out my extended interviews with some of the world's great investors and financial thought leaders on wealthtrackextra.com. Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. It is common street wisdom that investors tend to invest looking at the rear view mirror instead of the window in front of them. If we look back over the past 3 decades, one of the clearest routes to investment success, with relatively few bumps along the way, was in the bond market. As you can see from this chart of 10-year Treasury notes, for instance, we have experienced a nearly 30-year ride of falling interest rates. In this case, from 15% in the early 1980s to the close to record lows of under 4% today. It is a trend that is just starting to reverse itself. Meanwhile, total rates of return on bonds, that's interest plus appreciation, have been largely positive. According to wealth management firm Wilmington Trust, taxable investment-grade bonds had relatively low volatility, posting negative 12-month total returns only 5.5% of the time. Annual returns range from a high of 35% to just a few episodes of single-digit losses. And the average return for corporates over the last 3 decades, a respectable 8.7%. Now contrast that to the roller coaster ride stocks have given us. As Wilmington Trust points out, volatility is the norm. Large cap U.S. stocks have posted negative 12-month total returns 22% of the time. The S&P 500's performance has ranged from 60% plus to a negative 40% plus. Over the 30-year period, stocks did deliver average annualized returns of 11.4%, but the S&P was flat to negative during the last lost decade. That's the long-term record. However, over the last 2 years, since the March 2009 lows, stocks have raced to the front and bonds have lagged seriously behind. Nonetheless, individual investors continue to overwhelmingly favor bonds and shun stocks. Are individual investors once again missing a significant market turn by looking back instead of ahead? We asked 2 stars of the bond world to join us on Wealth Track this week to give us their assessment. Kathleen Gaffney is the co-manager of the LumaSales Bond Fund with legendary bond fund manager Dan Fuss. She and her team were Morningstar's Fixed Income Fund Manager of the Year in 2009. And Martin Fridson, Global Credit Strategist for BNP Paribas Asset Management, is also considered to be the guru of high-yield debt, better known as below investment-grade junk bonds. I started by asking them if the best days of bonds are behind us.
I don't think the best days are over. They're going to be different days. And clearly we've seen the lows in interest rates, and there's risk mounting, but it's primarily mounting in the Treasury market. I think that's an area where investors generally think of a very safe asset class, and yet that's where a lot of the risk is today.
Marty, what's your response to that question, and also what Kathleen's analysis of it is?
Well, I would agree that the traction in the corporate area all across the quality spectrum is in part because the Treasury yields are so low, particularly in the short end of the yield curve, and that really makes higher yielding investments in the bond market attractive. A lot of capitals continue to flow in. People aren't looking for huge capital gains as we've had at past points in the cycle. As Kathleen says, there'll be ups and downs, and there will be some points along the way in which the gains will be realized. But really, for the income, there's not a great alternative in savings accounts, short-term treasuries, or other investments of that nature.
Which brings up my next question is that how should we view bonds now in an individual's portfolio? What does it do in the portfolio? It used to be that you would look at bonds that they represented stability and income. What do bonds represent now for a portfolio?
Well, they don't have a lot of stability if we're going to be facing a rising rate environment. And when you look at short rates, they're certainly not generating income. And I'm talking specifically treasuries. But as Marty mentioned, the fundamentals in the economy are very positive. The Fed is keeping interest rates low, and so there's an incentive to take different types of risk right now. Credit risk being a very attractive part of the fixed income market where you can pick up some additional yield, so you can generate some income. And as long as the economy continues to move in that direction, that's a pretty stable environment.
And when you're talking about credit, you're talking about corporate bonds.
Yes.
Right.
Investment grade and high yield.
And treasuries, the treasury market, which is a very intriguing conundrum, I think, for investors, because on the one hand, the treasury market was the place where you did go for stability. Supposedly it's risk-free. Mm-hmm. And what I'm hearing you say, Kathleen, is it's no longer risk-free. In fact, so Marty, how risky is the U.S. Treasury market for investors now, do you think, going forward?
Well, I think that you're going to have rate volatility because of the federal deficits that are running in the U.S., the repercussions of that all around the world. Europe has its own set of problems with the euro, and that has sent shockwaves around the world. At the moment, the emerging markets are doing fairly well, but that could be a different story a few years down the road. So you have to look at that volatility, and the great advantage of the corporate sector is you're insulated, particularly the further you go down the quality spectrum, the more you're insulated from that interest rate risk.
And that's a very interesting, point that you make, and I think a lot of individual investors don't realize that, is that you two talk about interest rate risk. And so Kathleen, explain, some bonds have more interest rate risks than others, and that's something that you're concerned about, interest rate risk. So, for instance, why are U.S. Treasuries considered to be, high interest rate risk investments, whereas corporate bonds might not be?
Let's see if I can do this in a way that makes sense. With interest rate risk, it all boils down to math, and that Treasuries offer liquidity, but then simply you are earning a coupon, you're earning an income over a period of time. And so the longer that time frame is to maturity when you get your principal back, there is a premium for the uncertainty about what happens to interest rates over that period of time. And so as interest rates rise, it means the value of those cash flows declines. And so bond prices go down when interest rates go up. And the longer the maturity with all of that uncertainty creates greater volatility. So the value of having liquidity is important, but you don't want to have that interest rate volatility. To avoid that, you look for a different type of premium where you can get paid for taking a different type of risk, and that's credit risk. So as you go further down in quality, you get a larger spread, a larger premium for taking on more credit risk. And so that's the trade-off that I think investors really need to focus on and educate themselves about, because in a positive economic environment, you're going to get compensated for that. So in the investment grade market right now, you have household names, Time Warner or a Comcast. Everyone's familiar with those names, and you think about lending money to a good company such as Time Warner or Comcast, and that does make sense, except that when premiums come down, the spread between that corporate bond and treasuries becomes very narrow. It's going to act more like a treasury bond because people feel so comfortable taking that type of risk. So you have to watch that value in order to determine how much interest rate sensitivity is even present in some types of corporate bonds.
That was a very good lesson in interest rate risk. Kelly did a very good job at doing that. Thank you very much. So Marty, what are you telling and what your clients, international clients, and what are your international clients telling you about how they view U.S. Treasuries?
There's a concern, certainly on the longer term, because the factor that has supported the high yield, the Treasury market, is that the U.S. is the reserve currency for the world. So we've been able to finance our deficits by borrowing from overseas. I think it's actually hurt us to an extent because we have that crutch to fall back on. Rather than getting our house in order, we always feel we can go borrow it from China in particular and other developing countries, in fact, that have turned into surplus nations over time. And it makes it too easy for us not to face the problems we have. My saying about this is it's time for Daddy to take away the credit card. And
from the government,
well,
right.
That's right.
Right.
But in the meantime, the rates probably would be higher in the U.S. if not for this factor. And the concern is that at some point, the lenders will lose patience and say we can no longer view the dollar as the sole reserve currency. Perhaps we have to put the euro on an equal footing or come up with some other mechanism, some mixture of currencies. And that could be quite devastating to Treasury rates down the road.
So let's deal with the reality that we have. We've got a bond market where interest rates are starting to rise. Right, and do you both basically think that interest rates, it's inevitable that interest rates are going to rise from here, and therefore it's going to be a very fluid situation in the bond market?
Yes, interest rates are going to rise. I think it's important to realize, though, that that's going to be a very gradual process. We're still we're in recovery. We're not seeing expansion. And that's really a key difference, that normally when you enter into a period of recovery, you see several quarters of 5 or 6% growth. We're going to be happy if we get to 3. So it's growth, it's positive, but it's very modest. And that means that interest rates aren't going to shoot up dramatically. So it is a good time to not rock the boat quickly, collect coupons, and look around for where you see value.
So Marty, where do you see value? And I'm looking at you. You are considered to be the high yield guru in this country. So is there value in high yield? Some people call them junk bonds. Is that where the value proposition is, or where are you seeing value in the bond market?
You know, we see them as fairly valued at this point, and the total return should be pretty attractive over the next
high
year.
yield.
In the high yield end of the market. They're not cheap on a valuation basis at this point, but in contrast to the view of some, we don't see them as rich. The capital has continued to flow in, and that should continue with rates at the short end of the yield curve being kept very low by Federal Reserve policy. So, and the default rate, a very important determinant of performance, not only because of the direct losses that result from those bonds at default, but because the risk premium, the spread in yield over the treasuries is determined in an important way by the default rate. And that clearly is headed down. I don't think there's too much controversy about that. It came down from 13% in 2009 to 3%, which
wow, that's a big drop.
Yeah, and that's I think was somewhat artificial in how quickly it happened. I think it would have taken 2 years rather than 1 had it not been for the massive Federal Reserve intervention and also extraordinary measures by the Treasury. But it's pretty strong consensus and not at all unfounded or just a matter of opinion, but it looks pretty clear that the default rate will continue to decline.
Even
probably
from
to-
3%
yeah,
among
probably
high-yield
about 2% in 2011. The investment grade market also looks very well valued. In fact, by our analysis, even cheaper relative to the intrinsic value at the moment than the high yield market. The reasons are not that obvious to me why it is as attractive as it is, but the fact remains that you're getting a good compensation for the risk that's in the investment grade corporate market.
So what is your take on high yield, first of all, at the Loomis Sayles Bond Fund? And I know that's an area that you have been invested in.
We are allowed to hold up to 35%, and we are just about there. I very much agree with Marty's comments that it's a fairly valued market. I think when you dig into how we're positioned, a couple of things stand out. One, that, as I mentioned, we're in a very modest recovery. So generally, that's a good time to take credit risk, but not to go too far down in quality. That without higher rates of growth, it can be a challenging environment for very low quality high yield bonds. So we're avoiding triple Cs, which is that very low quality end, and yet we do see a recovery. So we want to take some types of risk. And what we're doing is we're looking at convertible bonds. That's a great sector, inefficient because it has qualities of both fixed income and equity.
And convertible bonds in the high yield issuers, in the triple B or lower, or?
Triple B or lower, but we've also found some great ideas in the investment grade area as well. And really all we're trying to capture is, knowing that there's a rising rate environment, we want to find bonds that have the ability to go up in price as opposed to bonds that are going to fall in price just because interest rates are going one way. And so if you can find good companies that can de-lever through their convertible bonds, helps their balance sheet in the long run. Or we're really trying to find global market leaders, because the global economy is where the growth is. And if you can find companies like an Intel, you should see there are attractive valuations right now, and you want to capture some of that upside. So different ways of taking risk in the market right now.
Marty, where are you seeing value for your clients? You just said in the high yield area it's fairly valued, right? So are there any other areas looking around the world that represent, really good value in the bond markets?
Well, there's a lot of appeal to emerging markets, and which is not really an area we're involved in, but you hear increasingly investors saying that they are shifting in that direction, possibly moving within a portfolio or creating a new mandate in that area. And that is a reflection in part of the expectations of high growth in that part of the global economy.
Right.
A lot of those are rapidly industrializing countries, and despite the overall sluggishness of the economy in the developed countries, they're starting from lower bases and have a lot of room to grow. Again, they generally have put their fiscal houses in better shape than they have been in the past. Many of them are commodity producers that benefit from a general recovery in the economy. We're certainly seeing upward pressure on commodity prices pretty much across the board currently. So they have that attraction from a basic economic standpoint. The offset to that is that they, in many cases, don't have the same legal context that bond investors like to invest in. You have to be very conscious of your rights in the event of default. And if you look at countries like the United States, Canada, Great Britain, Australia, they have a similar system of laws that people are comfortable with, generally good bankruptcy codes that give you some predictability. So when you're talking about emerging markets, you have to figure that you need to spread the risk around fairly broadly, because in any particular name or country that you run into a credit problem of that kind, you may not have a good outcome.
And Kathleen, I know that you at Loomis Sayles have looked at emerging market bonds as well, and also in certainly commodity countries.
Yes.
And so what's your strategy with those areas now?
We do think that non-dollar in general is a source of great long-term value. That as the global economy becomes more balanced, you're going to see appreciation out of the developing world. And so that is Mexico, Brazil, and in Asia, the peripheral countries, so Malaysia and Singapore. But we also are always looking for liquidity, and if we're not viewing the U.S. Treasury market as attractive long-term, some other government markets do offer liquidity and appreciation potential through the currency. Such as Canada, which has been a long-time holding for us, and it's the commodity currencies benefiting from that very strong growth around the world and much sounder balance sheets than what we're seeing here in the U.S., Europe, and Japan. That they have a current account surplus and they'll be attracting flows, and we'll see those currencies appreciate as well.
And I know that what you call the current account surplus countries, Canada is one of them, but Australia, Norway,
New Zealand,
and New Zealand. So are these
the good guys?
These are the good guys.
Yes.
And whose government debt is still attractive, and for all of those reasons that you just mentioned.
Attractive, liquid, and you're picking up a little bit of yield, and we'll do that wherever we can.
Municipal bonds in this country. There has been a rout in the municipal bond market recently. Is it justified? Marty, do you want to delve into that, or?
Municipalities have a very serious long-term problem with promises they've made to their employees. They have not done a good job of funding those liabilities, basically retirement liabilities. That's by and large not a problem that's coming immediately. So I don't want to minimize it, put it off, but I think that the difference between the fiscal situation of states and cities right now is being confused with this longer term liability, and I think the specter of massive wave of defaults being imminent has been somewhat overstated and probably is generating some opportunities. And there's also a possibility that those longer term problems will be resolved. It's not an easy thing to do. You can't just easily go in and say we're going to renege on the promises that we've made. It may in some form come down to that. There may be no real alternative but to renegotiate even benefits that have previously been promised.
Kathleen, opportunities in the municipal bond market. I mean, I've heard that there are some pension funds crossing over to buy munis, which they have never done before because the yields are so attractive. Are you finding them attractive as well?
They've certainly gotten our attention. It's looking like it is an opportunity. Again, I agree with Marty that this will be resolved. But in thinking about fixed income portfolios today and trying to avoid taking interest rate risk, there's uncertainty about the state and local agencies and how these problems, which are essentially credit problems, are going to be resolved. There's a risk premium that's being built into the marketplace. That's the type of risk that I'd be more willing to take in this type of an environment.
So for individuals then, rather than fleeing the municipal bond market, in fact, they might want to consider looking at them and almost in a new way as well, just because there are some real opportunities there for
Yes. And it looks
returns.
like taxes are going to be going up at some point as well, so the value in munis will clearly come back again.
Kathleen, your advice to individual investors who are sitting on bond portfolios that might have some pretty decent profits as interest rates look like they're going to start rising?
It's always good to be short and high in quality in that environment, although there's a huge opportunity cost for longer term investors. So I think that you have to start thinking about fixed income a little bit differently. Think global, think multi-sector. There are still a number of different opportunities to be found where you can have high total returns, even in a challenging environment.
One investment for a long-term diversified portfolio, what would each of you recommend that we own some of? Marty Fridson?
A high yield bond fund as part of a larger portfolio that will be diversifying risks that you're taking in the equity market, in the high grade corporate market, but I think that it will serve you well over a period of time, not as a trading vehicle, but as a generator of income over a very long period.
Kathleen, one investment?
tough question in a market that's been running and everything has done well. When I think about what's been left behind and where there might still be value is in the home builders. And that could be either a stock or a bond. But
Or a convertible.
Or a convertible. You have your choice. But the large home builder public companies, such as a Lennar, look to be of good value right now.
And good value and good quality?
Yes, I think so. I think that the worst is behind us for the home builders, and this is a good time to step in.
So Kathleen Gaffney and Marty Fritson, thank you so much for joining us with all of your insights on this fascinating market that is the bond market on Wealth Track. We really appreciate it.
Thank you.
With those ideas in mind, we're going to conclude this edition of Wealth Track. Next week, we are switching asset classes and focusing on small is beautiful. We have a television exclusive with great investor Chuck Royce of the Royce Funds, whose name is synonymous with small cap stocks. Think their best days are behind them? Well, wait until you hear what the legendary Chuck Royce has to say. In the meantime, to watch this program again, just go to our website, wealthtrack.com, to see it as a podcast or streaming video. Thank you for watching, and make the week ahead a profitable and a productive one. Einhorn, Berkowitz, Grantham, Miller, Swenson. Learn as much as I do from these rare conversations with our exceptional guests. Check out my extended interviews with some of the world's great investors and financial thought leaders on wealthtrackextra.com.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally. Research Affiliates, an efficient index for an inefficient market. The Wintergreen Fund, your home for global value. Rosalind P. Walter and the Dreamin Foundation.